morning, everybody. Our apologies for the slight delay getting started. We were having a minor bit of technical difficulty when ReadyTalk didn't like one of our slides, so a little bit of working around, and looks like we're up and ready to go. So, thank you very much for joining us for the March Enterprise Risk Management Toolbox webinar. A couple of housekeeping notes before we get started. If you've dialed in by phone but haven't logged in by web and you'd like to see the slides that will be shown, please point your web browser to readytalk.com. In the box where it says Participant Join a Meeting, enter the same code that you used to join the call, 9879821. Please stay aware of the level of background noise in your area, and if it starts to become noisy, please put your phone on mute. If your phone doesn't have a mute function, you can use ReadyTalk controls, which are *6 to mute and *7 to unmute. If you're called away from your phone, we ask that you please do not put your phone on hold because that will transmit your hold music to everybody on the call. So if you need to leave, you can simply hang up, dial back in when you're available, and that won't disrupt the webinar. We are leaving the phone lines open, so you can ask questions as they come up. Also, the chat box is available. If you'd like to type a question into the chat box, I will relay it to our presenter when we get an opportune moment. With that, I will hand the controls over to our illustrious Interim Chief Risk Officer, Cheryl Lloyd. Cheryl?
All right, good morning, everyone.
Good morning.
All right, so I have people out there that can hear me. Great. So this is going to be kind of fun today, particularly for those of us who tend to be insurance geeks in the world. But we're going to do a smattering of risk financing and insurance, and it truly is an incomplete history because as things develop and change, so does the discipline of risk. And from years and years ago, when it was really just somebody needing a little coverage to make a shipment when it crossed the seas, it has grown into a significant discipline that's very complex and looks at the strategic risk for all types of institutions. So today we're going to quickly go through kind of what's risk management as a discipline. Is it an art or is it a science? Or is it both? We're going to look at some risk financing techniques. We're going to talk a little bit about the insurance market, talk a little bit about third-party administrators, and looks like we're also getting an update on risk services. So this is kind of what most people think about when they think about insurance. This is the post-1960s phenomenon. Even though it has deeper foundations, risk management as it's practiced today is essentially a post-1960s phenomenon. Insurance buying. The predecessor function of risk management is insurance buying. And like I said, a lot of people still think that's what it is. Although insurance is very widely used, larger organizations like the University of California, we've reduced our reliance on insurance and on more conventional arrangements and discovered that insurance doesn't always meet our organizational needs or the internal activities that can control the impact of risk and uncertainty in an organization. This will be familiar to many of you in our discipline. Risk is a hazard that may happen. It's really a human activity which integrates the recognition of risk, assessment, developing strategies to mitigate and manage risk. And we use managerial resources to get that done. This is classic textbook risk management here, where a risk manager should always look for a way to transfer the risk, avoid the risk, reduce it, or accepting it. And in doing all of those, there's consequences that are related to each one of those techniques. So there's our little guy with this question mark. No one really likes uncertainty. But in the world of risk, that's what we deal with every day. And the outcomes can be negative or positive. And often what we try to do in risk management is to if it's going to be a negative outcome, maybe we can reduce it, maybe we can mitigate that outcome, maybe we can make it a little more palatable for us. And our definitions evolve. And like I said before, we really went out to purchase a lot of insurance, but now we spend a lot of time identifying the risk, assessing the risk, and coming up with a response. So if someone brings an issue to someone in risk management, you have to find out where are the issues that we need to be concerned about. And then kind of walk through a risk assessment test to determine, is this a risk we want to transfer? And what our response should be. So I'm going to talk to you a little bit about travel risk, which is one of the risks that we manage in the university. So probably about a couple of campuses had a delegation that they wanted to send to Afghanistan. Now that's a risk. It's a country that, is most folks would consider a considerable risk, and a lot of folks would wonder, why would we send people there? But in our business of being a research institution, we send people all over the world. And so I think of UC San Diego, which actually has a department that's called Global Conflict, right? And where do those researchers go? They go where the conflict is. Or I'll give you another example. When the earthquake and tsunami hit in Japan a few years ago, we were helping people get out of Japan. However, we had researchers, engineers, and physicians who were being summoned to Japan by the Japanese government. So they needed to go into Japan. So that's the kind of business that we're in. We go where the risk is. So our job as a risk manager is to take a look at what the risk is and how to address that. So when the campuses came to us with folks that wanted to go to Afghanistan, we said, okay, that looks like a risk. So let's go out and shop and buy some insurance to protect you in the event that you get sick, in the event that there's some civil unrest and we need to move you out. And so, part of that was identifying what the risk was, where they're going, what's the trip going to look like, doing an assessment of that particular risk, how long are they going to be there, what's out there in the marketplace that can handle it, and then having a response or a plan to put in place if something were to go wrong. And so that's what we do here in our office kind of on a day-to-day basis. Campuses call us, they pitch to us the various different risks, and we come up with ways to manage it. Let's talk about enterprise risk management. So a lot of our world has really moved into the world of enterprise risk management because traditionally we really kind of operated in this left quadrant of hazard risk. But enterprise risk management are the methods and processes that are used to manage all of these types of risk, possible events or circumstances that can have an influence on the enterprise in question. By identifying and proactively treating such potential risk, one protects the very existence of the institution, the resources, human and capital, products, services, or customers of the enterprise, as well as external effects on society, markets, or the environment. ERM includes elements of traditional risk management, but also includes more strategic risks, such as credit and market risk, as well as reputational risk. And those of us in the university are quite familiar with kind of seeing some of these other components that may not have been in traditional risk management, particularly, you're familiar with on your campuses how issues can rise and become a significant reputational risk for a university. Any of our universities, we are often in the newspaper for various different things that come up. And so these are issues that we deal with on a day-to-day basis. We still work within the risk management framework. It provides a foundation, really, for applying the risk management process throughout the organization. Well, now here's a fun slide. Lots of moving parts, right? This is the Enterprise Risk Management Framework, and this process model illustrates the components of a framework and the steps of a process. This model uses key concepts from various international risk management standards and is just one of the many forms an ERM framework and process can take. Each organization really should adopt an ERM framework and process that best meets its needs. An organization's framework and process should be reviewed periodically to make sure they continue to meet the organization's needs, because an organization changes, and so maybe what we started 7 years ago may not necessarily be the answer today. This model also illustrates that the risk management process occurs within and is supported by the risk management framework. The risk management process occurs at various levels and applies to various functions throughout the organization. Typically, the framework will be established by an organization's senior management and chief risk officer, while the process may be established by just the chief risk officer or another risk management professional. The 4 components of the risk management framework model demonstrate the organization's commitment to risk management and to help drive the integration of risk management throughout the organization. The framework components also support the risk management process. They're not meant to be carried out in any particular order, and an organization should adapt the components to suit its specific circumstances. So oftentimes you'll see that, ERM in banking looks one way, but how ERM in banking looks is not necessarily how it should look for our type of business. Sure, the same framework may apply, but the actual process may be different. And as you know, multiple frameworks exist, and an organization should really choose the framework that best supports its operations. 2 of the best known and recognized international standards are COSO, issued in 2004 by the Committee of Sponsoring Organizations of the Treadway Commission, and ISO 31000, published in 2009 by the International Organization for Standardization. The COSO framework is derived from a financial controls orientation and places a great degree of responsibility on the organization's board, requiring them to both publicly support ERM, really, showing the tone from the top, and also have a direct involvement in the ERM process. ISO 31000 places emphasis on risk management as a strategic discipline for making risk-adjusted decisions rather than as a compliance-based function, and it's much less controls-oriented. So what is the role of the chief risk officer? We talked earlier about, strategies include transferring risk to another party, avoiding risk, etc., accepting, but also the risk officer needs to establish the risk management policies, define what the roles and responsibilities are, develop a functional risk management framework, promote risk management competence in the organization, and establish a common language, reporting, and monitoring mechanisms. And, we have to be cognizant of the fact that those of us who are in insurance and risk, and really disciples of the discipline of ERM, we do tend to speak our own language, but it's important when speaking with our customers, our clients out on the campuses, our constituent departments, that we're making sure that people understand really in common language that we really want them to manage their day-to-day risk. So ERM, is it an art or is it a science? And who really owns it? Is it risk? Is it the controllers? Because we do have to implement controls, but that's a part of managing risk. Or, is it the responsibility, who's responsible for compliance? And look at that. This represents kind of us. Is it, the regents? Is it the administration? There's our controllers, faculty and research. Now, I wish you guys were here in front of me because I want to ask you the question, who is really the owner of risk? We all are. Everyone is a risk manager. And yes, your hat may look like this because there's many different pieces that make up what we do from day to day. We just cannot wear the one hat. We have to wear a hat that has many different facets to it. And so for those of you who are not from the local Bay Area, this is one of the stars of Beach Blanket Babylon. And if you've ever been to their show, of course, they wear a lot of real fancy hats. So there's your answer, everyone. All right. Key risk financing concepts. So we walk through these steps every day. Self-insurance. Should we maintain some level of self-insurance for a risk as it's presented to us? Self-funded insurance. How about unfunded? Where we don't really put aside any money for any kind for the exposure as we see it, or it's a new exposure and we don't really know that much about it. Excess insurance, reinsurance, captive. Some of this we're going to go through in detail. You've heard us, or you hear us from day to day talk a lot about self-insurance programs. And really what we do is we have a level of self-insurance programs within our programs. So if you take our workers' compensation program or our professional liability program, the first $5 million of that, or depending on the program, it could be $7.5 million, is self-insurance, meaning the first dollar spent on every claim is the university's dollar. If it's a significant claim and rises above that $5 million threshold, then we have excess insurance behind it. And for an institution of our size, we have to have significant excess insurance. We have over $50 billion in property assets. We can't even go out into the marketplace and buy that much insurance. So, but one significant fire on one of our campuses could wipe out our retention and some of our excess layers. So we have to use many of these concepts together to manage our particular risk. Something that is I always find people get very surprised about is we do not carry quake insurance. And people, shock, horror, dismay. I have a couple of people in my office, and that's how they're looking at me, in horror. How do we not have earthquake insurance? Well, as large as we are, with all of our assets primarily in the state of California, there's no insurance company that's stepping up to the plate that really wants to write our excess coverage. They're really kind of afraid of us. Because say if we had an earthquake in Southern California, it could affect multiple campuses. Same thing if we had an earthquake in Northern California. It could affect multiple campuses. So no one is really anxious to to sell us a insurance policy for earthquake. Permissibly self-insured is a term that refers to something like workers' comp. Workers' comp is a mandated coverage by the state of California. You have to have it. You either have to buy it, you can also buy it from the state, but you have to have some type of insurance to protect your injured workers. And if you don't, then you have to go to the state of California and say, hey, we would like to permissibly self-insure workers' compensation in the state of California. And that's what we do. We self-insure it up to a point, say $5 million, but above that we do purchase excess insurance over that. All right, I'm going to move on to the next slide because we're going to cover some of these other areas. So how do we do that? Now, a lot of you know me, Cheryl Lloyd. I simply don't sit here and count how many assets do we have and then decide how that's supposed to be done. There's a whole team of us here in the Office of Risk Services, and we rely heavily on our actuaries. We asked them to calculate our insurance and risk premiums, to figure out the probability of particular events, not necessarily birth, marriage, illness, and death, but catastrophic events. I talked to the actuary yesterday, and I asked him to add a little factor for kind of the weird stuff. Those of you who are used to being in our university environment, sometimes we have things come up that we don't even know are going to come up. When I joined the university many, many years ago, we had claims that rose out of our willed body donation programs, people who donate their bodies to science, and then some of their family members sued the universities, 2 campuses, and said that we did not treat the cremains or their family members' bodies as they thought we should. And it was quite a prolonged piece of litigation. We developed case law out of it about when you donate a body, it's treated differently than when you take it to a mortuary. One of the things I learned is when you donate a body, of course, that's what our medical students use to learn how to be physicians. So that you shouldn't expect that we're going to treat the body the same way you do as when you take it to a mortuary, right? And so we were in years of litigation, and it cost the university over $10 million over a period of 10 years to kind of litigate through those claims. But the reality is, these were losses that no one really predicted. Fast forward a few years later, we had animal rights researchers that then presented threats to our campuses and our researchers. Well, there was costs that are related to protecting the researchers and protecting our campuses from those types of threats. Those types of things, no one sits up in the middle of the night and goes, I bet there's got a new threat that's going to come to us, and how should we address that threat? So sometimes you have to come up, and we ask our actuary to kind of develop a factor that's going to help us have a little cushion of money or resources where we can respond to those types of losses. A couple of years ago, pepper spray. So, one Saturday morning as I was watching the news, and I watched the officer from UC Davis spray the students, right? I turned to my husband and I go, this can't be good, right? And sure enough, it spun out into litigation, etc. Well, we don't have a pepper spray response fund where there's no such insurance as that. So we ask actuaries to help us predict for kind of unforeseen up in a year that we would have to manage and work.
I've got it.
Okay? So let's talk about Lloyd's of London, because some of you've heard, I leave next Tuesday. I'm on my way to London. And on my way back, I'm going to come through Bermuda. And someone says, really, Cheryl? What kind of job is that? You get to go to London and Bermuda. Well, I go to London to go meet with the various different insurance syndicates at Lloyd's of London. And Lloyd's of London, all right, now someone needs to mute their phone because you make a lot of noise. So, Lloyd's of London started really as a coffee house, Edward Lloyd's Coffee House. Okay, wait, isn't this kind of fun that I'm Cheryl Lloyd and I'm going to Lloyd's of London? Sorry, I do take a picture in front of the sign. I just want to let you know. But anyway, I digress. Lloyd's of London was a coffee house, and so merchants who would have their wares on ships and sell them from, say, Europe to Asia, they were subject to be, storms. Their ships would sink. They could run into pirates, etc. So they would want to get insurance as they made that trek across the seas, right? Well, at the coffee house, you'd have these different syndicates or individuals at that time who would agree to take a piece of the coverage. Nobody would want to insure the entire ship or the entire cargo, so they would take a piece of it, like, maybe John would take 10%, and maybe James would take 15%, and maybe, Adam would take, 20%, depending on what their resources were and how much they were willing to gamble, quite frankly, on the cargo that was going to be shipped. Therefore, if the ship went down, they would not lose their whole wad, rather they would only lose a percentage. That's the origin of Lloyd's. And if you go into Lloyd's of London right now, you would actually see a big bell that sits in the center of Lloyd's that they ring to that until this very day. If a ship goes down, they go and ring that bell, because that's really what the inception of their program was. So it's really kind of fascinating. In fact, a lot of the business is done by paper today. I mean, they do have computers, but really, last year when I went to London, I got to sit in the box with our property insurer and watch as brokers came up to him with various different programs and say, hey, I have Ross stores across the United States. And then the property broker would say something like, which states are they in? Well, those are pretty tough hurricane states. So I'll tell you what, I'll take 10% of that loss. And then he moves to the next box and he gets somebody to take another percentage of that loss. And that's what the broker does, actually, when they're at London. They try to fill the slip and get 100% coverage for their various different risks. And so this is a model that kind of shows how the corporation of Lloyd's works. Capital flows in, and then from the right side, and as you can see, the business comes in from the left side. I'm telling you, it was quite fascinating when I sat in the box last year to watch, how little of a percentage a particular syndicate might take, right? And so when I go, what I do is market UC to the syndicates. And let me show you a slide here that gives you all the various different syndicates. So I meet with these various different companies, like maybe 5 companies a day, an hour a meeting, breaks and lunch in the middle. I might have to have lunch with them, with a particular broker. But what I do is I give a presentation, and what I try to do is sell the university. This is kind of funny because in my professional development, I always said that I would never be a salesperson. But when I go to London, oh boy, I am a salesperson. You know what I sell? I sell you. I tell them about how fabulous you guys are, what wonderful environment, health, and safety departments we have that hopefully protect us against lab fires, what practices we have in place to prevent slip and falls, how our buildings are structured, which ones have sprinklers, what percentage have sprinklers, what we do to manage student risk. So we put together, in fact, our team here has been working on the PowerPoint for the Lloyd's trip. It's about, unfortunately, as I was looking at it last night, this is about 40 slides. But I give that presentation about 5 times a day when I'm in London and then on to Bermuda. And I have to give it, with different slants. The first part of my trip, I'll be meeting with the underwriters who write the general liability and the auto and the medical malpractice side of the business. So Kim Uscott will join me and talk about how safe we are in our hospitals. And I'm going to give a big chunk of that to him, too, to do that selling piece. And then the following week, I meet with the property underwriters. And once again, we switch a little bit. Gary Leonard will fly out, and we will give a presentation to the property underwriters about, the things that we do to protect our property on our campuses. So by the end of about 7 or 8 days, I know that presentation by heart, and unfortunately, so do the brokers that travel with me. They're like, oh, tell that story or talk about this particular issue. But that's really what I do. I, Cheryl Lloyd, who declared I'd never be a salesperson, for those 8 to 10 days, I am selling UC. And then what we do, I'm going to go back to the slide, we ask them to take various percentages. And the more comfortable the syndicate feels with us, with our management of our risk, with our organization, we take over our org charts, etc. The more comfortable they feel with us, then the more risk they'll take or they'll be willing to take. So it's my job to get them into a place where they feel fairly comfortable. Now, insurance is limited by the capacity in the marketplace. Each insurer has a certain limit that they put up every year that they're willing to spend. And so they have a fixed supply of insurance capacity over a period of time, and it's perishable. And so in the sense that unused capital for an underwriting year cannot be transferred to the next. So in essence, I'm competing with other insurers to get a limited piece of that syndicate's resources. So I want my story, I want them to feel better about me than USC. Well, sometimes they don't because that's only one campus, and so 10 kind of makes them a little nervous. But really, I'm in competition. And an insurer, a syndicate or a pure insurance company, they reduce their possible maximum loss on either an individual risk or a large number of risks by ceding a portion of that to reinsurance. They then transfer some of that risk so still that they're not bearing the whole brunt of the risk. And so reinsurance enables an insurance company to expand its capacity, stabilize its underwriting results, finance and expand volume. They can also secure catastrophe protection against big shock losses, and they can share those risks with other companies. So it's one big happy sharing family. You all have to be nice because you never know who you're going to be with next, you know. Now, the broker, and I travel when I go to London, I travel with our property and casualty broker, with our casualty broker Marsh, and I also travel with Alliant for our property side of the business. And they represent us, and not the insurance company. And they search around to find the best fit. You know, who's willing to write university risk? Who's willing to write large property? And so a broker can place that business with any kind of company. But you know, when I kind of teach this to some of our interns, I refer to the broker as kind of the personal shopper. I tell them what I'm looking for, and then they go out and find the best fit or the best company that can help with that particular that particular exposure. Let's talk a little bit about, we're jumping around here to different topics, but this is a little smattering of things that cross our paths. Third-party administration versus self-administration. So we don't handle our claims. We do not self-administer and process our own claims. We actually outsource that business to a third-party administrator. Third-party administrator is an organization that processes the claims without carrying the insurance risk. Third-party administrators are prominent players in the insurance industry, and they typically have expertise and capability to administer all or a portion of the claims process. And so insurance companies will contract with TPAs, but so do we as self-insurers, because that's really not our book of business. There are a lot of us who come from insurance companies like myself, and a lot of folks on our team here come from insurance companies. And a lot of us have processed claims. At one point in my career, I was a claims adjuster. And so, you know, if my car gets hit today, I can probably go out and appraise it and handle it. However, it is not what I do from day to day. And so it's important that we have people who kind of work in this business, keep up to date on laws that govern this particular area, particularly in something that's highly regulated like workers' compensation, and that they're able to manage our claims quickly and resolve them hopefully successfully without costing us that much. And so Another tool that we use is captive insurance. And so you've heard recently that the University of California formed its own captive. And it's called, wait for it, Fiat Lux, Let There Be Light. What a beautiful thing, right? So captive insurance companies are limited purpose insurance companies established with the specific objective of financing risks that come from their parent groups. Although sometimes they also insure risk of parent companies' customers. So in the simplest terms, it's an in-house self-insurance vehicle. Now, a lot of companies form captives, particularly if they're large, because we're able to write our own insurance policy to a certain extent. When we deal with an insurer, sometimes they want to limit what they're going to cover. But a captive allows us to expand what we're going to cover, and it allows us to write things we typically wouldn't write. We're looking at some creative uses of our captive. Over the years, people have said, well, you know, Cheryl, we provide, say in the professional liability world, we cover our doctors. A lot of other hospitals don't. They require their doctors to carry their own insurance. But we cover our doctors for liability insurance. Now, if they go work somewhere else, say they moonlight, they don't want to go buy a whole annual policy for the small amount of work they do somewhere else. But they might like to buy a partial policy. Having us form a captive allows us to put together that type of product if we wanted to sell that to our doctors. So a captive allows for a little more creativity in the realm of addressing all the exposures that we have. Most large organizations have captives. Walt Disney has captives. Oil companies have captives. Other colleges and universities, for example, Harvard, Stanford, have captives. And they also sell some of their consulting services. So right now on our professional liability program, we are buying services from Harvard. Their captive has a coding program that we purchase so that we can appropriately code our medical malpractice claims. So the captive is really a very sophisticated insurance in that we're, in essence, running our own insurance company. It's very new. We formed ours in 2012. And it's just, we're just starting to develop the captive and the products that it will offer. But it really is kind of the way to go for an industry of our size. So I believe this might be the last slide. So let me go back here. So when you're sitting out there on your campuses and you're wondering, what in the heck do those folks do at OP? What's Cheryl Lloyd up to? Why does she get to go to London and Bermuda? Who are these ERM folks, and why are we sending out an army of ERM folks out to the campuses? I hope today we've given you a little insight as to what our organization does and maybe help with some of the myths surrounding the insurance world. Emily, that's all I have. I don't know if any questions came in. I'd be happy to address them.
No.
Cheryl, it's Katie Pickard. You talked about going to London and meeting with underwriters and the various syndicates. When you go to Bermuda, what do you do?
When I go to Bermuda, I meet with excess insurance companies. So the various syndicates in London usually take maybe $50 million on various different flips. But say we had a fire in a dorm burned down, and we had, I know this is kind of nuts that I can think of like the worst things to happen. But, and there was a lot of death, et cetera, and we had significant claims. We need really extensive layers of insurance. And so Bermuda is where we go to meet with the super excess layers of insurance. They might write $100 million on top of 50 or on top of $100 million, up to maybe $200 million, depending on what we need. So
thank you.
Same trip, but a different folks, and the brokers and the insurance people wear Bermuda shorts.
Oh.
All right. I don't, though. I know that was kind of, some of you were thinking that. I don't. I dress appropriately and wear my business suit, but just going to let you know that sometimes folks show up with their Bermuda shorts on. Any other questions out there? All right, Emily, take it away.
All right. Well, we don't have any questions in the chat box, so I will thank everybody for dialing in today, and we hope to see you at future Enterprise Risk Management Toolbox webinars. Thanks very much, Cheryl.
Thank you.
Thank you, Cheryl.